Hey guys, Austin Schneider here, and in this video we're going to talk about how mortgage rates work. Guys, mortgage movements and interest rates can be a very confusing subject even to veteran mortgage borrowers. You know, why one day is it 3.75%, why the next is at 4%, and why have we seen mortgage rates go above 15%? Well, in this video we're going to break it down. We're going to talk about how mortgage rates are made, how mortgage rates movements happen, and how you can use this information to be sure that you can lock in a low interest rate. First things first, guys, what is a mortgage rate? Well, a mortgage rate is the interest that you will be paying on a loan. Some easy math: if you buy a home for $100,000, if you're getting a loan for $100,000 and your interest rate is 4%, then your interest is going to be $4,000 a year on this loan. As you probably know if you're watching this, or if you are a shopper, the goal of a mortgage shopper is to get the best rate possible. If we take the same example before, rather than a 4% rate, we break it down to a 3.5% rate on a $100,000 loan. Guys, that can save you $500 per year. So how do we ensure that we are getting the lowest rate possible? We're going to break this down. So it goes into 3 different factors. 1, the market. 2, the lender that you're working with. And 3, you. First, let's talk about the market. So the market actually has the biggest influence when it comes to your mortgage rate. You know, many people think that Fannie Mae, Freddie Mac, and the feds are what's controlling your mortgage rate. While they influence them, they don't control the overall mortgage rate. Rather, the mortgage rates are set by investors on Wall Street. Investors bid on a bond called mortgage-backed securities, and as demand for these mortgage-backed securities go up, the interest rates go down. So as a mortgage shopper, you want to be ready to lock in a good rate when the mortgage rates go down and the demand for mortgage-backed securities are up. So what are some times when mortgage-backed securities are in higher demand? Well, first things first is when the economy is not doing very well. When there's some uncertainty in the economy, investors are more likely to invest into these mortgage-backed securities. Another potential influence on the mortgage-backed securities being high in demand is when there's steady or falling inflation. And then another factor could be, political uncertainty or any wars that are going on. Why do these factors really control mortgage-backed securities and drive demand for mortgage-backed securities? Well, the main thing is that mortgage-backed securities are viewed as a safe asset. If there's economic uncertainty, or if there's war or something going on with political uncertainty, then the stocks are going to highly affect where these investors are putting their money. And those 3 factors influence what is going to happen in the stock market, where mortgage-backed securities are different. Stocks are risky when the economy isn't doing so well, so these investors aren't going to spend their money and invest in the stocks. Rather, they're going to put it in a safe investment like an MBS. Let's look at an example of how quickly these mortgage rates can change based off of the market. So let's say interest rates are floating around 4%. There's a lot of economic uncertainty, and there's a war going on overseas. Then one day everything changes. We get news of a uptick in the economy, and we're set for another rally, and we cease fire overseas. Guys, this can change overnight, and these investors will pull their money from the mortgage-backed securities into the stocks, knowing that we're set for another rally. And what that's going to do to the mortgages is make them rise. So when you're thinking about mortgage rates and how quickly they can change, it is volatile and it can change at any minute. So don't think that an institution just sets it and it's going to be nice and steady for a while. It is unpredictable and can go up at any minute. So if you're a home shopper or a potential home buyer, how can you keep an eye out for when the best time to buy for you or refinance for you is going to be based off the rates? You'll want to look for economic uncertainty, low inflation, and negative impacts on what's going on in the economy, because these investors are more likely to invest in the MBS, which will keep the rates nice and low. So just keep an eye out on the news, see what they're talking about when it comes to the economy, what the future holds for the economy, and if there's still uncertainty going on, that's a great time for you. In all, the market plays the biggest role on what your interest rate's going to end up being. One day it can be 4%, one day it can be 5%, or one day it could be up to 18% like what we've seen in the 80s. What we do know, if there's economic uncertainty, mortgage rates are likely to be low. But if we are heading towards another rally or the economy is doing really well, likely the mortgage rates are going to rise back up. So that's what you'll need to keep an eye out as a home buyer or a refinancer. Now let's look at the second factor that determines your rates, your lender. While lenders don't have full power to set the mortgage rates, to set the interest rates, they do have a lot more leeway than you may expect to get you a lower rate. We always recommend going to 3 to 4 different lenders to get you 3 to 4 different types of rates from different types of banks, institutions, to compare where you can be most competitive. For example, Bank A might charge a lower rate than Bank B, and as a consumer, as a mortgage shopper, you can start taking your rates to other banks and making them earn your business. Another thing to think about is some banks, some institutions are more competitive on different types of loans that you may be looking for. For instance, if Bank A is super competitive with FHA, but Bank B isn't as competitive with FHA, you'll probably want to steer more towards the Bank A because that's where you're going to be able to get the best rate for your situation. So loan types also do play a factor when it comes to your lender. It's hard to tell which banks will give you the best rate for your situation. So your best bet as a consumer, as a shopper, as a potential refinancer is to do the work, do the due diligence to get multiple quotes, because taking the time to do that could save you thousands of dollars in the long run. So we can't emphasize that enough, to take the time to get more than one quote, because your lender does play a factor when it comes to the rate. And if you are getting multiple quotes, try to get all of the quotes done in the same day. So get your lenders lined up immediately, because as we just talked about, interest rates could change immediately in one day and 1 hour. So you'll want to get the rates sooner than later so you can lock them in if they're competitive and work for your situation. Now, the third factor that determines mortgage rates is you as a consumer, you as a home buyer, you as a potential refinancer. Let's look at a couple examples when it comes to how you as a consumer can affect the mortgage rates. So buyer number one, Lisa, let's say that she is looking to purchase a home and she's going to live in the home and her credit score is 740. Now let's look at Mark, and Mark is looking to purchase a 4-unit home to rent out and has a credit score of 680. The lender knows that borrowers with lower credit scores are more likely to default on their mortgages. Plus, if it's a multi-unit property and a rental, they often experience higher foreclosure rates based off of the data that is accessible. And because of this, Mark is charged a higher interest rate versus Lisa, who planned to live in the home and has a higher credit score. So why are the mortgage rates different? Well, let's go back to the first factor that we talked about, which was the market. Let's remember that investors on Wall Street invest in MBS, mortgage-backed securities, to make a return on their investment. And the riskier the return, if you're viewed as a riskier borrower, they'll want to come out with a higher rate of return for their businesses, for their investments. So the higher interest rate is really just compensating for the higher risk that you entail as a borrower. So as a mortgage shopper, as you as a consumer, what you should be doing is focusing on improving your credit score and setting yourself up to be the least risky borrower that you can be. And this can be, improving your credit score, buying a single family house that you plan to live in. Condos and multifamily homes tend to have a little bit higher of an interest rate. One thing that a lot of people may get skewed up upon is the 20% down and 10% down, but really interest rates aren't too big of a factor when it comes to how much you're putting down, so don't let that skew you away from focusing on other areas of improvement before you focus on the down payment. All in all, guys, you may have been surprised of what really is controlling these mortgage rates, and hopefully this information was extremely useful for you as a borrower or as a potential refinancer. Understanding these can end up saving you thousands of dollars in the long run, if not tens of thousands of dollars in the long run. So we're really here just to ensure that you can be the most informed home shopper, home borrower out there. For more on this topic, for more about the mortgage rates and what's going on in the market, visit us online at themortgagereports.com. Thanks so much for watching. We will see you on the next one.